Okay, in this first video we're going to look at the major factors impacting Australia's international competitiveness. So the sort of things that you need to look at include the main ones are productivity, production costs, so there are three types of production costs that you need to focus on mainly, availability of natural resources, how exchange rates impact international competitiveness, relative rates of inflation, and then be able to assess how these impact our domestic macroeconomic goals. When you're defining international competitiveness, as I said to you in class, it's about a country's ability to compete on global markets for goods and services. So when we're talking about our ability to compete, that can be based on price or non-price factors, and those non-price factors are essentially quality factors. So it's about a country's ability to compete in global markets for goods and services based on price and quality. An improvement in our international competitiveness means that Australians are either producing products cheaper or at a higher quality compared to overseas. If you get asked to define the word international competition, what that means is referring to how many producers there are in an industry worldwide. So it's a little bit different to international competitiveness. So the first factor is productivity. If you get asked how does productivity impact our international competitiveness, define what productivity means. So it's the level of output per unit of input, and it's a measure of how efficiently we use our resources to produce goods and services. So it's output per unit of input, and it's looking at how efficiently we're producing goods and services. There's labour productivity, which is generally measured by GDP per hour worked, and capital productivity, this was looking at capital output per hour, and then multi-factor productivity, which is looking at the efficiency of both our labour and capital, and then how we're turning our natural resources and capital resources into production. So improvements in productivity are a favourable aggregate supply side factor, and they should boost our international competitiveness. The idea is that increased productivity, specifically if it goes up faster than our cost of production, should help to lower firms' average production costs and decrease prices. It's not always the case though. Increased productivity can occur and it not lead to increased international competitiveness, and that can occur if we increase our productivity but we don't actually pass the savings on to consumers. So if businesses become more productive but they decide to keep their prices high, then that won't actually help to boost our international competitiveness. So if they're in a market with a lack of competition, so if it's in oligopolies or monopolies in particular, where there's only one or a few major sellers, that can lead to productivity gains not actually leading to lower prices and increased international competitiveness. Having said that, the idea is that in the long term, if we become more productive, firms essentially have higher profits and they can use that to invest and become more internationally competitive in the long term. But if they just use the money, the decrease in production costs to boost their profit margins, that won't make us more competitive. When we're talking about trade liberalisation, which we will later in the chapter, the idea is to boost the level of global competition so firms are always seeking new ways to become productive and innovative so that they're able to become more competitive going forward. Production costs are the second one. As I said to you, there are three main types of production costs you need to be aware of. So the three main costs are labour costs, and when I mention labour costs, the main one would be wages, but also includes costs related to superannuation, leave entitlements for employees, workers' compensation. Capital costs are mainly the cost of machinery, and then raw material costs, which include things like energy costs, so gas and electricity, transportation, and things like that. So the cost of raw materials is another key cost. When any of these costs fall, it helps to boost our international competitiveness. So the main one at the moment, if you're doing a question on name something that's causing our international competitiveness to increase, it's the decrease in the cost of labour. In recent years, labour costs have fallen due to weak labour markets. So not only have we got unemployment above the target range, which is currently at about 5.4%, we've also got underemployment at the moment of around 8 or 9%, which is leading to a lot of spare capacity. So the supply of labour is outweighing demand. Demand for full-time workers is continuing to fall, and that's all leading to downward pressure on production costs because it's keeping wages down, and that can all help to reduce inflationary pressures and boost our international competitiveness. The cost of labour is a key thing keeping production costs down because of the spare capacity in the labour market. In terms of capital costs, global capital costs have fallen due to advances in technology, so businesses' capital productivity has improved, and that's reducing the cost of capital per unit of output, and therefore using the real cost of using capital in production. This is particularly good for Australia because Australia is particularly capital intensive. So lower capital costs benefit Australia more than our trading partners because they may be more labour intensive where we're generally more capital intensive. So advances in technology have helped to reduce the average cost of production, particularly in Australia, and boost our international competitiveness against more labour-intensive countries. And the last one is raw material costs. Raw material costs include the costs of things like energy and electricity. There has been some increases in recent months and years because of investment in this sector. They've had to pay a lot of money for infrastructure, to create power poles, to expand the size of energy networks and electricity networks. Some other factors that caused higher costs of raw materials in recent years has been the carbon tax, which has now been removed. That led to higher energy prices. And there's also been a shift in recent years towards investing in renewable energy, and that's cost a lot of money in terms of investment, and we've had to bear a lot of the costs of those in terms as consumers. So the shift away from non-renewable to renewable energy sources, while it will be good in the long term, has had some negative impact on our international competitiveness because it costs more to run. Availability of natural resources is the third factor. So countries with richer resource endowments, so that can include richer soil, increased access to minerals below the ground, will all make us more competitive. Countries that spend significant amounts of money on finding ways to invest and explore those minerals will also be better off because then they can use those and sell them to the rest of the world. So changes to the climate can also impact the overall productivity of our land. The idea is that all these factors related to us having better quality land resources and richer soil help us to encourage us to boost our comparative advantage over other countries and help to boost our international competitiveness. So Australia's comparative advantage lies largely in mining and agriculture. This allows us to produce those goods and services at a lower price. This could be depleted in the future. So one reason why Australia will be affected more by climate change than other countries is because we are so heavily reliant on natural resources. So a lot of our competitiveness comes from our cheap natural resources, and therefore if climate change depletes our resources through natural disasters and intense droughts and poorer soil, that's going to reduce our international competitiveness. And last one, exchange rates. Lower demand for the Australian dollar will result from factors that make our international sector less competitive. So slow productivity growth and higher production costs can all lead to a lower Australian dollar. Higher production costs and reduced productivity lead to higher prices, reducing our international competitiveness, and can also reduce the dollar. So a decrease in international competitiveness can lead to a reduction in our dollar because we sell less exports and potentially purchase more imports over time. The depreciation of the exchange rate, though, in itself can help to restore our international competitiveness. So if we're becoming less internationally competitive because of weak productivity and higher production costs, the fact that that depreciates the dollar does help to restore that a little bit. So because we have a floating exchange rate, that acts as a bit of a buffer when the economy, when export growth is weak, and we're not being very productive and inflation may be higher, the lower dollar helps to act as a buffer to try and boost growth. This automatically falls in response to our economy being less competitive, which helps to restore competitiveness and international competitiveness. A very efficient competitive economy is likely to see an exchange rate appreciation, which can then decrease our competitiveness. So essentially, the worse off we are in terms of our exports and how when we're less competitive and less efficient, that is bad, but it can have positive effects for keeping the dollar down, which boosts international competitiveness. The vast value of the dollar is also impacted by other overseas events. So higher productivity in China can lead to an increase in demand for the renminbi, appreciating the Chinese currency. This is likely to lead to a lower Australian dollar relative to foreign currencies, which will help to boost our international competitiveness. So when other countries have increased productivity, that can help to increase their dollar, which makes ours lower, which can restore our competitiveness a little bit. Countries can often manipulate their exchange rate to try and boost competitiveness. So often countries will undervalue their currency with the idea that that will promote exports and promote production and incomes. And the RBA also intervenes by buying and selling foreign currency. So sometimes they will use their foreign currency to buy Australian dollars to make the dollar higher, or they'll sell Australian dollars and buy a foreign currency to make it lower as well. Thank you.